Stop what you're doing. What I'm about to share with you isn't another silver hype video. This is different. JPMorgan Chase, one of the most powerful financial institutions on planet Earth, just did something they never do. They issued a public warning about silver, not a casual mention, not a footnote in a quarterly report, a warning. And the number they attached to it should make every investor over 40 pay very close attention. $187 per ounce. But here's what they're not telling you in that headline. The real story is what's happening in their vaults right now. And it's not pretty. Let me start with something you need to understand about JPMorgan. They don't panic. They don't issue warnings unless something fundamental has shifted beneath the surface. This is a bank that survived 2008. A bank that has been accused of manipulating precious metals markets for years. A bank that's paid billions in fines and still operates at the center of global finance. When they speak publicly about a specific price target in a commodity market, especially one they've been so deeply involved in, you don't ignore it. You listen. And then you ask the harder question, what do they know that we don't? Here's what's happening right now, and most investors under 40 are too busy chasing the next crypto token or AI stock to notice. But you and I, we've been around long enough to recognize a pattern when we see one. We remember what happened before major market dislocations. We remember the warning signs that everyone else ignored. And right now, every single one of those signs is flashing red in the silver market. JPMorgan's vault inventories are collapsing. Not declining, collapsing. We are talking about physical silver disappearing from their storage facilities at a rate that should concern anyone who understands how commodity markets actually function. These aren't paper contracts moving around on a screen. This is actual metal, bars weighing 60 to 70 pounds each, walking out the door. And when physical inventory leaves a major bank's vault, it's going somewhere specific. It's going to buyers who want possession. Buyers who don't trust the paper game anymore. Now, why does this matter to you? Because JPMorgan isn't just any player in the silver market. They're the player. For years, they've been the largest holder of physical silver among the big banks. They've been the house in this casino. And when the house starts running low on chips, when they start publicly discussing price targets that are 3 times higher than current levels, that's not analysis. That's revelation. They're telling you what they see coming because they can't hide it anymore. Let's talk about that $187 number for a moment. Where does that come from? It's not random. It's not picked out of thin air to generate headlines. That number represents their calculation of where silver needs to trade based on current supply and demand fundamentals. Think about what that means. Right now, silver is trading in the low 70s. They're saying it needs to go to 187 just to reach equilibrium. Not as a speculative target, as a rebalancing mechanism. But here's where it gets really interesting, and this is something your financial advisor probably isn't telling you. That 187 number assumes normal market conditions. It assumes supply chains function. It assumes mining production continues at current rates. It assumes industrial demand doesn't accelerate beyond projections. What happens if any of those assumptions break? What happens if we're not in normal conditions? You've lived through enough market cycles to know that when things break, they don't break gradually. They break suddenly. The assumptions that held for years stop holding in a matter of weeks. And silver, with its unique position as both an industrial metal and a monetary metal, sits at the exact intersection of multiple breaking points right now. Let us talk about those vault inventories in detail because this is where the story gets uncomfortable for anyone betting against this market. JPMorgan's COMEX eligible silver stockpiles have dropped by over 60% in the last 18 months. 60%. That's not a correction. That's not normal fluctuation. That's systematic drainage. And it's not just JPMorgan. It's happening across multiple vaults, across multiple storage facilities. The physical silver that's supposed to back all those paper contracts and ETFs is disappearing. Now, where's it going? That's the question that should keep you up at night. Some of it's going to industrial users who are securing supply ahead of projected shortages. Solar panel manufacturers, electronics companies, medical device makers, they're not waiting around hoping silver will be available when they need it. They're buying now and storing it themselves. That's unprecedented behavior in this market. Some of it is going to wealthy individuals and family offices who are diversifying out of purely financial assets. These aren't Reddit traders. These aren't kids speculating with stimulus checks. These are people with serious capital who've decided that physical precious metals need to be part of their wealth preservation strategy. And they're not buying paper. They're buying metal. They're taking delivery. They're putting it in private storage. Some of it's going overseas, to Asia, to the Middle East, to regions where they have never fully trusted Western financial systems, and recent events have only reinforced that skepticism. When you see silver flowing out of New York and London and showing up in Singapore and Dubai and Shanghai, that's capital voting with its feet. That's wealth moving from systems it no longer trusts to systems it believes will honor property rights. But here's what JPMorgan knows that they're not saying out loud in that warning. They know that once physical inventory falls below a certain threshold, the paper market loses credibility. Think about it like a bank run. As long as everyone believes they can get their cash when they want it, the system functions. The moment that belief cracks, the moment people start questioning whether the metal actually exists to back all those contracts, the whole structure becomes unstable. And we're approaching that moment. Maybe not this month, maybe not this quarter. But the trajectory is clear. Every month, more metal leaves the vaults. Every month, the ratio of paper claims to physical metal gets worse. Every month, the system becomes more fragile. JPMorgan can see this. They have the data. They have the intelligence. And now they're telling you, in their own way, that this ends with much higher prices. Now let's talk about why this matters specifically to investors. Over 40. You're in a different position than younger investors. You've accumulated wealth over decades. You've built retirement accounts. You've paid off mortgages. You've done the responsible things. And right now, most of that wealth is probably sitting in stocks, bonds, maybe some real estate. Traditional assets that have worked for the last 40 years. But here's the uncomfortable truth. The next 10 years might not look like the last 40. The conditions that made those traditional assets perform so well, stable currencies, declining interest rates, globalization, consistent growth, those conditions are shifting. Some would say they've already shifted. And in that new environment, in a world of persistent inflation, currency instability, geopolitical fragmentation, you need different tools. Silver isn't a replacement for your entire portfolio, but it's insurance. It's a hedge against the scenarios that would destroy the value of everything else you own. And unlike insurance on your house or your car, where you pay premiums and hope you never need it, silver is an asset that maintains intrinsic value. It's been money for 5,000 years. It's not going to zero. JPMorgan's warning about $187 silver is really a warning about everything else. It's a warning about the dollar, about debt, about monetary policy, about the stability of the financial system that you've trusted your whole life. They're saying, in the language of markets, that the old rules are breaking down. And when the rules break down, you want to own things that have value independent of anyone's promise to pay. Let's talk about the math for a second, because this is important for rational decision making. If silver goes from $70 to $187, that's a 167% return. Not 10%, not 20%, 167%. Now, could you lose money? Of course. Silver is volatile. It could pull back. It could frustrate you for months. But what's the downside scenario? That it goes back to 50? To 40? At those levels, industrial demand would absorb everything available. The floor under silver is much higher than most people realize because of that industrial bid. So you're looking at asymmetric risk, limited downside, because industrial users will buy everything that comes to market below a certain price. Substantial upside if JP Morgan's analysis is correct, and unlimited upside if the situation gets worse than their base case assumes. That's the kind of risk reward that seasoned investors should find interesting. But here's where most people get it wrong, and I want you to avoid this mistake. They see a price target like 187, and they think that's the top. They think that's where you sell. That's backwards. If silver gets to 187 because of the conditions JP Morgan is describing, that's not the end. That's the beginning. Because at 187, you're still dealing with supply deficits. You're still dealing with currency concerns. You're still dealing with all the factors that pushed it that high in the first place. The real move happens after the mainstream realizes what's happening, after CNBC starts covering it daily, after your neighbor asks you about silver stocks, after financial advisors who've ignored precious metals for a decade suddenly become experts. That's when you see the parabolic phase. That's when 187 becomes 300 or 400 or higher, not because of speculation, because of panic buying by people who waited too long. Now, let's address the elephant in the room. JP Morgan has been accused of manipulating silver markets. They've paid fines. They've been sued. Why should we trust anything they say? That's a fair question. And here's my answer. We're not trusting them. We're listening to them. There's a difference. When someone who's been on the other side of a trade suddenly switches their public position, that tells you something. It tells you the trade has flipped. It tells you the dynamics have changed so fundamentally that their old strategy doesn't work anymore. Think about what it means for JP Morgan to issue a bullish silver warning. They're essentially admitting that the game they've been playing is ending. They're telling their clients, their counterparties, the market at large, that holding paper short positions against silver is dangerous now. That's an extraordinary admission from an institution that's been on the short side of this trade for years. The vault inventory collapse is the proof. You can manipulate paper prices with enough capital and leverage, but you can't manipulate physical inventory. You either have the metal or you don't. And right now, they don't have enough. That's not an opinion. That's not analysis. That's observable fact in the delivery data. So what should you do with this information? I'm not going to tell you to rush out and put your life savings into silver. That's not investment advice. That's not prudent. But I will tell you what I'm seeing. I'm seeing one of the world's largest banks, a bank with more information than you or I will ever have, telling the market that silver needs to triple from here just to reach fair value. I'm seeing their vault inventories draining at an accelerating rate. I'm seeing industrial demand that's not going away. I'm seeing supply constraints that take years to fix. And I'm seeing a market that's still skeptical, a market where most investors aren't positioned, a market where mining stocks are cheap relative to the metal, a market that could deliver the kind of returns that become life-changing for people who position early and stay patient. You're at a stage of life where you can't afford to lose everything chasing the next meme stock, but you also can't afford to miss the major wealth transfers that happen during monetary transitions. And that's what this is. This isn't just about silver going up. It's about a transition in how we think about money, about value, about trust in institutions. Silver is just the symptom. The disease is much deeper. JPMorgan knows this. That's why they issue the warning. That's why they attach that specific number. That's why they're letting their inventory drain rather than defending a paper price. They're repositioning for what comes next. The question is whether you are. Here's what I want you to think about. Not what you should buy, not what percentage of your portfolio should be in precious metals. Just think about this question. If JP Morgan is right, if silver goes to $187 because the supply-demand imbalance they're describing plays out, what does that mean for everything else? What does it mean for your bond portfolio, for your bank deposits, for your confidence in the currency you've used your entire life? Because that's the real warning. Silver at 187 isn't the scary part. What it represents is the scary part. It represents a world where the assumptions that guided your financial life for 40 years no longer hold, where the institutions you trusted are admitting they can't maintain the old order, where physical assets matter more than financial promises. You've built wealth by being responsible, by saving, by investing prudently, by trusting the system. And for most of your life, that system rewarded that trust. But systems change. And the smart money, the patient money, the money that survives transitions, starts positioning before the change is obvious to everyone. JP Morgan just told you the change is coming. They told you the price. They showed you the evidence in their draining vaults. They did everything except put up a flashing neon sign. Now the question is simple. Do you listen? Do you at least investigate? Do you take a small position as insurance against the scenarios they're describing? Or do you assume that everything will continue as it has? That the next 10 years will look like the last 40? That institutions will be honest? That currencies will hold value? That markets will function normally? That supply chains will heal? That geopolitical stability will return? I can't answer that for you. But I can tell you that JP Morgan has made their bet. And they're not betting on business as usual. They're betting on $187 silver. They're betting on a world where vault inventories matter more than paper contracts. They're betting on a transition that most people aren't prepared for. The opportunity is in front of you, not as a guarantee, not as a sure thing, but as a high probability scenario backed by data from one of the most informed institutions in global finance. What you do with that information is up to you. But years from now, when silver is trading at prices that seem impossible today, you'll remember this moment, you'll remember the warning, and you'll know whether you listened or ignored it. The vault inventories are collapsing. The warning has been issued. The number is 187. The question is whether you're prepared for what comes next.